He was appointed as the Indian Competent Authority under India's tax treaties and Joint Secretary, Government of India in July 2013 and functioned till June 2016. He led India's participation in the G20 OECD BEPS project and is credited with having secured greater understanding and global appreciation of India's policy and implementation in the field of international taxation and transfer pricing. It is our privilege to have him here. I now request him to discuss on the topic, multilateralism in tax and its impact on domestic tax policy. Over to you, sir.
Right. Thank you. Thank you, Soumya, for that very extensive, comprehensive introduction. I thought you guys would have compressed it a bit and then brought it out. But yeah, but thanks a lot for all the nice things said. And I'm also equally happy to be here with all of you, interacting with all of you. I think this is a very prestigious course, and nice to be talking to people from different services, different backgrounds, all have had some exposure of public policy and are now, I think, gearing up for even bigger roles in their careers. So tax policy, of course, has always been treated a bit separately from economic policy, although it is now, I think, the core of any major economic policy. Because more and more countries are realizing that that a sound economic policy overall has to have a very good tax policy at its core. And that's why I think this topic is very opportune. And when you talk of public policy, it's not just administrative or economic matters, but tax is very much a part of all this life. So let me start by saying that well, taxation is a sovereign function. I think it's a truth which is acknowledged by all. Every ruler, every elected government, every dictator, whoever is in charge of a country's administration has the full authority to levy tax on its people. And no other sovereign nation can really question that. So if France, for example, wants to tax somebody at 45%, India can't say that, look, I think that's too high, you shouldn't do that. Or if British Virgin Islands don't want to tax income at all, then again, this is not for us to say that, look, why are you doing that? So, so it's a sovereign function. All that has to be kept in mind is that the policymakers then decide who is to pay the tax and how much of tax is to be paid. Now, when you talk of who, there could be various ways of defining this group of taxpayers. And right now, I understand that many of you may not be fully versed with tax laws. So I think something of a little bit of basics on tax. So internationally, it has been found that there must be some sort of a nexus between the person and the country which wants to tax, and a period of stay above a certain limit or a normal residence in that country is now accepted as a basis for considering taxability. So the residence principle then says that any person who is resident in a country or a jurisdiction can be taxed by that country and can be taxed on his global income. So there are other countries. There are some countries who go by citizenship. The US, for example, in some circumstances, says that even citizens of the US who are not living in the US can also be US taxpayers. But then that's an aberration sort of thing. Mainly, the principle is that residence above a certain number of days in a year is supposed to be enough to allow the country to tax. Then how much to tax? And that's a question that, of course, depends upon the resources that the country needs and the income levels that people have. But the principle again here is that direct tax must be a progressive levy. It must, the levy of tax increases with the amount of income that is being earned. So it's based on that principle of ability to pay. Whoever has a higher ability to pay will pay more tax. And that's the fundamental logic behind this progressive income tax structure. You're all aware that there are different slabs of tax rates ranging from 5% to 30% at the moment in India. So, so it's a progressive tax based on the principle of ability to pay. And along with these basic ideas, then comes those pillars on which the tax system has to be formulated. Those pillars are of simplicity, of tax neutrality, and efficiency. Simplicity, of course, a tax law has to be simple, a levy has to be simple so that people can comply with it and the government can administer it. Neutrality is important because which means that two people carrying on the same sort of a business should not be taxed differently. You can't just levy different kinds of tax because one person is black and one person is white if they are doing the same activity or the same business. So that's again a fundamental principle. We are not, tax is not concerned with anything else apart from the business activity which is performed or the profession which is being performed. And third, of course, is efficiency, which means that tax laws should not lead or should not persuade people to make choices that they would normally not make. So, for example, if a tax system allows a huge incentive for locating your business in a certain area, a backward area of the country, then you're forcing people to make a choice to locate the business in that area. And there may be several problems that the businessman might face. But then just because the tax is lower, you are asking him to locate it in that jurisdiction. And that makes it inefficient because that investment will never really come out as a very fruitful investment. And the costs of running a business might be much more than the benefit that accrue from a lower tax rate. So our tax system must be efficient in the sense that it must not make people take wrong choices or choices that they do not normally make, and that it should not impede business in any way also. So to have a very restrictive tax policy which stops business in its tracks, I think that again is something which is not desirable. So efficiency means all these things. Don't force a person to do a business in a certain manner. Don't stop that business activity in any way. Don't create hurdles in that activity. Let people do what they want. Let enterprise come up. Let them earn their incomes. All that they must then do is pay tax on the income that they earn. So these are the principles of taxation, which I think all countries are basically following their tax policy. And as I said, since it's a sovereign function, therefore every country sets its own policy. But then as time went on over the past decades, you are aware of the increasing trend of trade amongst countries, the increasing globalization. And as trade increased, the participation of persons of one country in the business activities in another country started also increasing. With increasing trade came those questions that, look, this person is selling so much of stuff to my country, and he's not paying any tax in my country. So there has to be some way of putting a standard that, look, in such circumstances you must pay some tax, and in these circumstances you may not pay any tax at all. And that's brought the focus of tax policy people onto what activity is carried out in a particular source jurisdiction. So if Rolls-Royce PLC supplies aero engines to Air India, it just supplies the air engines. and there is no other activity carried out in India, then there is no source of income really of Rolls-Royce PLC from India, because it just an order has been placed, goods are shipped from that port in UK, and the goods reach Air India in India. So there is no activity of Rolls-Royce PLC, no business carried out in India. There is no source. But if Rolls-Royce PLC also sets up a maintenance unit in India, sets up a service center, sets up a marketing office in India, then it is carrying out business activities in India, and there is a source of income from India. So this thinking, this way of deciding as to whether in the globalized era, whether a country should pay tax, whether a company should pay tax in a particular country or not, and to what extent it should pay that tax, this gave rise to this principle of source, and that's now something which is an extremely important principle as far as most developing countries are concerned. So we have now the residence principle and the source principle, and all and a tax system globally are all based on a mixture of these two principles. There are some countries which would then say that, okay, their own residents will pay tax on their global income, but non-residents will pay tax only on the income sourced from that country. That's the policy that we follow in India. Or there could be countries who say that they're not concerned about residents and non-residents. They only tax income which is sourced in that country. It must arise in that country. That's called the territorial principle. But there are a few countries who follow that. But by and large, the system is that just as the government of India does, it taxes its own residents on their global worldwide income, giving credit for taxes paid in other countries, and then or for non-residents, it taxes the income only to the extent it is sourced from India, and to the extent it is attributable to the operations carried out in India. So this residence and the source principle are something which had been accepted by the international community. Post Second World War II, comprehensive tax rules came out when they were formulated, and they were obviously formulated by the advanced economies, the economies of countries who had won the war, and these were countries who were in a bad shape. They had to get the industry moving, and it is my personal belief that the tax policy that they formulated at that time, and which became global templates, were heavily in favor of the producing countries, the economies which were producing goods and services, the economies which had technology, which had capital, and therefore could produce these things which could be exported to different parts of the world. So and that then implies that these enterprises who are based in the advanced economies would not like to pay tax in other countries where they are operating, and because they would like to optimize their tax cost. So there has been a tussle between the taxpayer and the tax authorities as to how much of income is sourced from my country. You are actually doing a business in my country or not, and do I have the right to tax you or not? And there's a whole amount of litigation which is spawned because of these disputes. But this residence versus source principle and the laws that were framed, the principles that were framed on this basis, continued over the years, for several years, since the Second World War. Even when countries like India went into the globalized era of 1990s, we felt the pinch. We saw people, multinational enterprises coming into India, carrying out various activities in India, but not paying tax, because they always managed to structure their operation in such a way that one could not establish a source of income from India. Um, and the only concession then there was that countries could enter into tax treaties on a bilateral level, and there the two countries could agree that, all right, this sort of income can be taxed by you, this sort of income will be taxed by me, or this is the extent to which you will both tax a certain income, and this is the way in which we'll give credit for taxes that are paid in either country. So a bilateral basis of taxation, um, old principles of residence versus source, which heavily favored the producer economies, and acted against the importers of capital and technology. That was a system which carried on for years together. It still is in many ways, but then there have been some modifications in the past 15 or 10, 12 years. In fact, the next major change came in 2008 at the time of the global meltdown, the financial meltdown, where large economies were really received a setback. They went into recession, their growth slowed, they needed resources. And that's the time when even these very large economies started feeling that the current tax rules, which were actually supposed to be in their favor, were not really giving them the revenue that they should be getting. They realized that multinational enterprises had been too smart. They had been able to analyze the different laws of different countries. They had been able to look at tax treaties, bilateral tax treaties between different sets of countries, and they were able to find ways or find structures which would result in the same amount of business activity but a much lower tax burden for the enterprise as a whole. So it's not just by locating companies or enterprises in tax havens, but even otherwise by structuring transactions in a way that the income flows would not be taxed at all, or could be taxed at a very low figure. So everybody has read, we are all aware, people talk about Google paying only just about 4% tax, 4% of its income globally, if you look at it. And there are several examples of that which people keep citing. So that was a problem. It is very clear that multinationals were just not paying the tax even in their residence countries, and of course paying very little tax at all in source jurisdictions like India and other developing economies. And and that's when the beginning of this multilateralism in tax policy started, and that's the topic that I'm talking to you about today. And this was the background in which multilateralism came into a big way in the formulation of international tax policy and even in domestic tax policy. So when countries realized that multinational enterprises had become a class of their own, then there was a need to change tax laws. There was a need to modify tax rules. There was a need to ensure that these tax treaties could not be used by people, by enterprises to avoid tax. And there was a need to ensure that countries don't lose out on revenue just because of some artificial structured arrangements that these multinational enterprises were entering into. And that was the genesis of the BEPS project, the Base Erosion and Profit Shifting project, which of course with this, the idea was born in the OECD, which is a gathering or group of these very developed economies. But then it really got momentum after the G20 endorsed that action. The G20, as you're aware, is the collection of the major, the largest economies of the world, including economies like India, Brazil, China, and South Africa. And this G20 then, this political endorsement which the G20 uh, gave life to this movement for reform, the BEPS project, and which came to be known as the G20 OECD BEPS project. This project, as the name suggests, was designed to plug the loopholes, designed to make changes in existing rules so as to prevent profit shifting and so as to preserve the tax bases of countries. It was not a project which was supposed to change the entire architecture of international tax globally. It was supposed to plug loopholes. It was and that's why there were 15 action points. There were some action points which required changes to tax treaties. There were some action points which recommended domestic tax policies of a similar nature, all designed to provide a disincentive or to block the ways in which multinationals could avoid tax. The most important outcome of that BEPS project, all the reports were delivered in 2015. It was a successful project in the sense that it wasn't too ambitious, but it achieved what it set out to achieve. Most importantly, it was successful because it achieved a consensus amongst a large number of countries. The initial BEPS recommendations were endorsed by not just the OECD countries, the OECD is a group of about 36 countries, but also by the non-OECD G20 countries, which were about 8. So a 45-country bloc unanimously and with full consensus endorsed these BEPS recommendations. And that was the turning point, let's say, in the history of formulation of tax policy, the advent of multilateralism. And it could not have been otherwise, because even if a country as powerful as the US would have said that, no, I think we should change the rules here, we should ensure that the tax treaties don't talk of so-and-so clauses or don't allow tax avoidance, there was no way in which they could have really enforced that, because again, tax is a sovereign function. So it was not possible to tell other countries that, look, please modify your tax treaties or modify your own domestic tax policy. It therefore required consensus, and consensus could only come through a multilateral process. So this huge, and then subsequently this consensus which was achieved in the BEPS project came to be agreed to by as many as 135 countries. Right now, there is a inclusive framework which is comprised of 137 countries, which is tasked with implementing or ensuring the implementation of the BEPS recommendations. So a major success for multilateralism. And also, as I said, the fact that tax had suddenly become an important policy instrument, had suddenly become something which politics was much involved with, and that organizations like the G20, who would keep writing reams on financing and development flows, now started writing paragraphs after paragraphs on tax measures in their communiques. So suddenly we once saw tax assuming a very major role in international discussions and in international agreements. So that was the success of the BEPS project, the advent of multilateralism, the achievement of consensus, even though there were widely disparate views of different countries, but still there was a large amount of consensus achieved, and the political endorsement from the major bloc of countries, the G20. One of the major things of the BEPS project, as you would aware, was that it prescribed that tax treaties would contain clauses to say that the treaty is not meant to enable tax avoidance, or not meant to enable treaty shopping in any way, or to use a treaty to avoid tax. It also recommended that certain changes or additional clauses in the treaty, which would say that if an enterprise was trying to take advantage of a particular treaty to reduce its tax, and the reduction in the tax was one of the principal purposes of that strategy or that business strategy, then the tax authorities could deny the treaty benefits to that enterprise, because they're terming this activity as tax avoidance. That's something which is known as the principal purpose test. So and many other proposals came in for changes in treaties, and these were implemented. Very importantly, for the first time, the BEPS project drafted a multilateral treaty, a multilateral instrument. As I said earlier, tax treaties till then had been only bilateral agreements, two countries sitting down and agreeing to a set of tax measures. But the BEPS project gave rise to the multilateral instrument, the MLI, which is called. And this is a sort of a treaty which was to be entered into by all the countries who were agreeing to it, and right now has already been agreed to or signed by 85 odd countries. And by doing so, all these countries then agreed that these clauses in the multilateral instrument would modify their existing tax treaties with different countries. So the result is that even if my India's treaty with the Singapore does not have a clause of an anti-avoidance clause, the fact that both India and Singapore have signed the multilateral instrument incorporates that anti-avoidance clause into the India-Singapore treaty. So by one stroke, a multilateral instrument is modifying or has been able to modify dozens or hundreds of tax treaties amongst different countries. So that's a major entry of multilateralism into the formulation of tax policy. Apart from this treaty measures, there were a number of recommendations on domestic measures, with countries being requested to implement those measures. For example, the limitation on interest payments, deductibility of interest payments. You're aware that any interest payment made by an Indian company, payment made to anyone, is a deduction from the taxable income. Multinational groups could structure things in a way that interest payments could reduce the taxable income to a large extent, and wherever these interest payments were going, it would not result in that amount of tax. So a limitation on the amount of interest that could be deductible was one of the recommendations of the BEPS project, and India has actually enacted a law limiting such deduction to 30% of EBITDA. So many countries have done the same. So even domestic tax policy was influenced in a large manner way by the recommendations of the BEPS project. And that's why I say that this was the first major foray or entry of multilateralism into the formulation of tax policy. Along with the BEPS project, there was another movement, which is again a multilateral movement. Countries again realized that in addition to enterprises taking advantage of tax treaties, high net worth individuals or the really wealthy individuals were able to stash their money or their wealth in various hidden locations all over the world without their country getting any idea of the existence of such assets or such incomes. So any amount of money could be parked in financial accounts maintained in so many different countries, not just Switzerland, not just Luxembourg, but so Ireland, so many other countries which would allow a favorable regime for maintaining those financial accounts, which would allow a certain amount of secrecy attached to those accounts. And it was entirely possible for individuals to stash their unaccounted assets or the unaccounted wealth in different countries all over the world. Uh, so the problem here was a lack of transparency. There were several jurisdictions, several countries like Switzerland, like the Virgin Islands, uh, so many of the Cayman Islands, who were completely non-transparent about financial account information. One could open an account without giving one's name. One could set up a company by holding only bearer shares. One could be completely anonymous, completely hidden from view, but still be able to control assets located in those countries. So that's because these jurisdictions followed policies which were not transparent, which would not allow them to uh, part with this information or to share the information with other countries. And that gave rise to again another multilateral effort on tax transparency. And US started it by enacting a law called FATCA. I don't know how many of you are aware of that. FATCA stands for Foreign Account Compliance Tax Act. The US Act law, which said it was sometime in 2011, I think, and which required all other countries to report to the US IRS details of accounts held in those countries by US taxpayers. Now, this was something amazing, something going beyond your own jurisdiction. You are directing other governments to report on accounts held by US taxpayers in their own countries. So, but then the US could do it, and the US then insisted on that countries enter into agreements with the United States, agreements that would force them to collect this information in their respective countries and pass it on to the US IRS. Of course, the threat was that if you don't enter into such agreement with the US, well, then your global trade is going to be impacted adversely because almost all the global trade gets cleared in the US. It gets cleared in dollars. Severe restrictions can be placed by US banks in which would cripple trade. India also entered into this agreement of FATCA with the United States, which require now. So, and this was followed by the OECD, which coming up with its own reporting standard. Now, they said that since it is already being done by so many countries with the US, let us have a system in which every country shares information with every other country. And so a common reporting standard was developed by the OECD sometime around 2013. This standard says that every country, let's take the example of India, India will enact laws requiring all its financial institutions, banks, mutual funds, brokerages, depositories, etc., all its financial institutions to identify accounts held by non-resident taxpayers and then to report the details of that account to the Indian tax administration, who would then disseminate that information to the respective tax jurisdictions. So LIC mutual fund, for example, would have to find out details of the unit holders who were non-residents or who were not Indian taxpayer but taxpayers of the US or for other countries, and report that information to the Indian government. The Indian government would then pass on those details of accounts to the respective countries under the tax treaties. And this common reporting standard got developed. It was accompanied by a formal multilateral agreement, which more than 100 countries signed, and by which all these countries then agreed to collect this information and pass it on to the other jurisdictions. This is one of the major success stories of international taxation. Again, something which the G20 takes a lot of credit for. In fact, the only notable achievements of the G20 in the last 5-6 years have been on the tax front. The BEPS project, the common reporting standard, and the information exchange. So that has become a reality. It is something which was not conceivable earlier, but has become a reality, with countries coming forward and agreeing to part with the information from their own financial institutions to other countries in return for them passing on the information in turn. So again, a major story of multilateralism, the major way in which multilateralism has entered into the formulation of domestic tax policy. So India has formulated laws in its own domestic act. Other countries formulated similar laws. Everybody agreed to the format of the law. Everybody agreed to the manner of exchange and how, in what way the information would be submitted and transmitted. And it's something which is functioning now. India every year is sending out hundreds of thousands of pieces of information to other countries. We are receiving similar millions of information from other countries. So the second impact of multilateralism on domestic policy. And in this, these two major success stories of the BEPS project and the information exchange program, which is known as the AEOI, the automatic exchange of information. That's something which has now become the base for all formulation of tax policy. And which brings me to the concluding part of what I was going to say. This is not the end of the story, or this is not the end of multilateralism. Because even the BEPS project, as I said, only plugged certain loopholes. It only made certain provisions to ensure that tax avoidance would come down. But there were two things that the BEPS project did not do, or could not agree on. One was to suggest changes in tax laws in view of the increasing digitalization of businesses, of economies. And it was realized by countries during the BEPS project. In fact, one of the action points was on this, on the challenges, the tax challenges of the digital economy as it's known. But then it was also realized that it was now becoming possible for multinational enterprises headquartered in one country to carry out business actually in 50 different countries without having any physical presence in those countries. They could do this in a digital format. Very common examples of Facebook and Google, of course, and I don't need to expand on that. You will be aware. The way that the Google search engine or the Google got popular in different countries, and then the advertising income which started flowing into Google's coffers, all this happening without Google having its own setup or business activity in India. Of course, you set up a subsidiary in India, and that subsidiary, of course, is meant for collecting payments, for giving out some information, but not the actual activity. The actual activity is done from remote locations. So this was realized in the BEPS project that this is possible. It was also realized that many traditional businesses had now incorporated a lot of technology in them. So while earlier it was necessary to set up a brick and mortar office in a country to start selling in that country, now it was not required at all. It was possible to through the use of technology to carry out large scale marketing and publicity campaigns without having any sort of office or physical presence in that country. And this enabled those enterprises to avoid paying tax in those countries, because all the tax rules still say that a physical presence is necessary for a country to tax the income of a multinational enterprise. So until Facebook is physically present in India, I cannot really tax Facebook in India. I can tax the Indian subsidiary of Facebook, yes, but then, as I said, the income of that subsidiary is very restricted. Its functions are restricted to some marketing, some publicity, some information gathering, some reporting. But the main chunk of income which Facebook earns or collects from India is transmitted abroad. It goes straight into Ireland or to the US. Similarly with Google. So, so this was all realized, but then the BEPS could not achieve a consensus as to how to deal with it. India was at the forefront of countries insisting that we must find a way to tax this income. We must then find rules or make rules which can allow a country to tax such income, even if there is no physical presence of that enterprise in that country. But then these voices got drowned out because all the major such companies, internet companies, were headquartered in the US. And the US completely stonewalled any possibility of a consensus on this point. So the BEPS did not come out with any recommendations. It only came out with some analysis and some options that could be considered in this regard. But India didn't stop at that. We as you might know, in 2016, we enacted something called the equalization levy. And that's a very unique form of tax. It's not really income tax, but it is but at the same time, it is not a GST or an indirect tax also. It is a tax on the amount of revenue which flows out of India on account of advertising income. So that was a unique way of taxing it. India started the process in 2016, and subsequently many countries have followed suit, and many other countries are proposing to implement such levies. But that was a way to say, to make a statement that we believed in India that this income must be taxed. And if there is no consensus on modifying tax treaties, then we will find a levy which is not impacted by the tax treaties. So the equalization levy is not an income tax which is subject to tax treaty regulations. It is a levy which is an entirely different form of tax. And since tax treaties do not impact it, therefore now there is no necessity of a physical presence. India can tax this income only on the basis of the amount of revenue which is going out of Indian shores. So, so this emphasis on digitalization and then the challenges posed by digitalization was something that could not be agreed then, because many countries like India started these levies of equalization levy. These were unilateral measures. These are measures which would get tax, of course, for the country, but would also result in double taxation. Because when I collect equalization levy from Google, it pays tax in India and it also pays tax in the US or in Ireland or wherever. So there is double taxation on the same amount of income. But then there is no option at the moment, countries had gone ahead with this sort of a unilateral levy, and that's how the second phase of tax reform of multilateral discussion started, and which is now still ongoing in an organization called the Inclusive Framework. Again, with the backing of the G20 nations, the OECD has set up an inclusive framework, which now has about 137 country members. And the major task that it is engaged in is trying to find a solution as to how should this income, which is coming out due to massive digitalization, can be taxed in different countries, and how this income should be allocated. Again, it's been a difficult process. The discussions have been going on for the last 2-3 years. There are people who would say that they don't think anything is really going to come out of it. But then I think a lot of work has gone into it, and may not have to get the results that we would have hoped for. But then certainly this discussions will end in some sort of a consensus, which will be a step forward. And we are looking forward to that. Of course, the earlier commitment was to find this solution by December 2020. Now, because of the COVID complications, I think the probably postponed by about 4 to 6 months. But some sort of a consensus is going to come in, but then this again requires a huge multilateral effort. As I said, now it is not just 20 or 30 or 40 countries which are discussing, as was being done in the BEPS project. Now it is 137 countries who are actually actively discussing these issues and trying to come to a consensus agreement. And the agreement has to be by full consensus. And that's one of the major things out there. So as and when this solution is found, it will be I think in the end of bilateral policy making, or in fact signal a huge contribution of multilateral impact on domestic tax policy. There are other things going on in discussion. The problem of tax havens. There, of course, which is known as the Pillar 2 proposals, are designed to ensure that multinationals pay an average amount of tax, a minimum average amount of tax. As you know, I mean, they could structure their operations in a way by using tax havens to lower their average tax liability. But there is a move and there are some rules being discussed, and which will be agreed upon, which will ensure that multinational enterprises will have to pay some minimum amount of tax globally on the global profits. So again, something which is being discussed and agreed to by 137 countries. So that's where we are now, friends. From 75 years ago, when tax policy was supposed to be purely the domain of an individual country, it left to the government of the day to implement in whatever manner it wanted to. Then expanded into a bilateral concession where said that okay, two countries can sit down together and chalk out a way of an understanding amongst them as to how much of who should tax what, and to that extent compromise on their own tax policy, on their own sovereign tax rights. And then suddenly from 2008 onwards, this massive dose of multilateralism, the BEPS project, the automatic exchange of information, all codified in a multilateral format, all involving multilateral agreements signed and ratified by all countries, all based on consensus from a very large number of countries. And then finally to the current stage where the ongoing discussions, which involve an even larger group of countries, something which is extremely ambitious and which will result in some sort of a consensus, and then which will imply that every country then enacts a certain law in their domestic statute to take care of, or to implement the recommendations. So a huge influx of multilateralism, and that's why I thought it's something which people don't give much importance to, and I thought I must mention it in my brief talk to all of you. Times to come, I think when India, for example, sets its own domestic tax policy or tries to enter into the tax reforms, it has to keep in mind what is happening globally, what is its interaction with other economies, to what extent can India bring in changes in law. And I would just mention one recent amendment made in the Indian domestic law in the last budget in March 2020. An expanded form of equalization levy has been introduced, which now says that e-commerce operators, that would mean non-residents who are supplying goods or services through an internet platform or through certain digital facilities, will all have to pay a certain amount of tax in India, regardless of whether they have a physical presence here or not, and that 2% of the revenue that they earn from these activities will be deducted and retained as tax in India. That's a new equalization levy that's massive in its scope, but then it's something that it is sort of emphasizing the India's right to tax, and something which is coming out of the current need for resources. Every country wants resources at the moment. The COVID has really, as you are aware, COVID has pushed back economies, has pushed back the growth, and that the reduction in economies in several countries, including in India, and therefore there is a crying need for tax resources all over the world. And therefore these sort of levies will come in more force, in greater strength. And therefore solutions, more and more solutions will have to be found if these measures are do not result in any double taxation or unintended taxation. So this movement is going to continue, this of multilateralism. Domestic policy will get more and more influenced by multilateral developments, and that's the way that how we see tax policy evolving at present.
Respected sir, on behalf of the IIM Bangalore and batch of PGPPM 2021, I extend a hearty vote of thanks for sparing your precious time and addressing us on the complex subject of international taxation, base erosion and profit sharing, multilateral agreements, and in a very lucid manner. And so thank you so much on behalf of all the colleagues from Income Tax Department, sir. Thank you very much, sir.
Thank you, Mang, thank you, Amit and Amrit and everybody. It was lovely talking to you all. All the best wishes for your course.
Thank you so much, sir.
Thank you.
Thank you so much.
Thank you so much, sir.